After a sustained recovery, 2017 has seen the most bearish sentiment since the lower ranges almost a decade earlier. This can be seen in the short, medium, and long term, with bearish spikes in volume and price action forming a series of downswings that are starting to form a noticeable downward slope. The general outline of a head and shoulders does form along with a descending triangle. However, the lower support boundary in the lower 80s is never conclusively breached, and both patterns fail to produce a large drop. A primary reason behind this can be attributed to large bullish positions and sentiment still held from the bullish surge from November 2016. In the short to medium term, the prior highs around 93.70 begin to present considerable resistance as the upswing off the low 80s begins to decrease in bullish activity. This is a familiar situation with a neutral to increasingly bearish range presenting a noticeable slope. This turns out to be a normal moderate correction from a flat top range as a clear incline emerges following the completion of a bullish continuation. The 88 to 87 shoulder region of the failed head and shoulders was a key range into September since it repelled a moderate increase in selling pressure. As the main long-term uptrend remains intact, the short to medium term can be described as highly volatile and moving from neutral to bearish. A strict double top has a less effective 111.50 resistance area during sporadic volatility in the past few weeks that still sees bearish sentiment persisting. Despite the intersection of the long-term uptrend line and the 105 to 106 support range, strong bearish activity continues the influence of the double top. Although there were clear closes under 105.20, there weren't exceedingly large red candles with large volume spikes. Short-term sentiment was mainly indecisive, as opposed to a clear break like what was seen in March under 111.50. However, 106 to 105 is still a key lower boundary under pressure as another moderate bearish spike forms. In a rapid turn of events, selling pressure declines significantly, while moderate bullish activity produces a short-term surge back to prior highs. Taken in the broader context, most selling pressure was expended in earlier downswings onto the 105 to 106 range. Bullish sentiment was also still held at this same range, especially from the late November and early February periods. This again highlights the importance of observing short-term developments and taking into account the bigger picture. This is beneficial even if it is not directly related to a chart pattern, but rather a regular range of support, such as in this case. Back at previous highs, there is a concave triple top, with a minor delay in completing during a short-term bullish to neutral first week of October. After that, there was more than a sufficient surge in selling to put the 105 to 106 range back in the spotlight. This time, there is about the same general situation in terms of the bearish background in the short and medium term. Following another unsuccessful break from indecisive short-term trading just under 105, there is an overall neutral to bullish tone. The short-term downtrend line is broken, but the 111.50 area holds resistance. In fact, the concave triple top also gave way to a head and shoulders, in a more range-bound context. The sharp peak and failure to rise over 111.50 leads to the rapid completion of a bearish continuation in the long-term context. This strong drop eventually gets exhausted and begins reversing fittingly at a major level. In this case, the old 9370 level now presents major long-term support. When JPM recovers and eventually reaches newer highs, there are plenty of neat swing points contained within the ranges under 118.70, and plenty of regular bullish volume for a stable uptrend with regular bearish retracements. There is a fairly strict double top, but it has greater volatility in the sharp peaks and around the mid-130s to 140s range. It is also normal to see flatter trading before and after a double top, but here it is to a greater degree in December and February, around the 136 to 138 area compared to many other examples. Such activity points to greater indecision before and after the double top's formation. As would be expected, the old 83 to 118 range becomes an invaluable reference for support during the ensuing downtrend. Similar to before, it contains many neat downswing points during a slow recovery that sees a clear decrease in selling volume towards November 2020, as bullish volume increases moderately during the return back to the double top range. The upper descending trend line also marks the approximate area where the 118.70 area would present increased resistance potential. Naturally, the double top at prior major highs presents clear resistance, even to the steepening uptrend, and 118.70 presents a key lower boundary to slow down any major corrections in the future.